Test 1, 2, 3. Recording in progress.
All right. Good morning, everyone. Good morning, fellow trustee, staff, and our guests. Thank you for being here so early, bright and early. Some of us were here Monday, so thank you for being here again. Let's make it a great day. Linda, do you mind to take the roll call?
Sure. Thank you, Chair Mee. This meeting is being conducted as a virtual and in-person meeting. So I will do roll call of the trustees to confirm attendance. Ms. Mee?
Yes.
Mr. Rue? Ms. Martinez? Ms. Martin? Mr. Jones?
Present.
Ms. Ginsburg? Here. Ms. Langton? Here. Mr. Gatto? Mr. Green? Staff participating in the meeting include the following: CIO John Grable, Deputy CIO Jude Perez, Chief Counsel Stephen Rice, and Principal Investment Officer Vache Masarajian. We also have a presentation from the Pew Capital Management Team. Trustees, please use your raise your hand option to be placed in the queue. At this time, we ask all meeting participants to mute their mics until you're ready to speak. And now we may proceed with the agenda.
Thank you, Linda. Do we have any trustee participating under AB 2449?
We do not.
Okay. So the next item on the agenda is approval of minutes. Do any trustee have any question or change to the minutes?
Since we don't have a quorum, we'll do the minutes at the end.
We can do that, definitely. So the next one on the agenda is public comment. Do we have any public comment?
We do not.
Okay, so that's the most excited item coming up. We have a very excited lineup of speaker. Thank you for joining us today. And I will pass to Vacha to give a pop introduction. Thank you.
Thank you, Madam Chair. Good morning, Madam Chair, committee members, and trustees. I'm pleased to welcome representatives of Pew Capital to the Credit and Risk Mitigation Committee meeting this morning. We're joined by founder Mary Pew, founder and CEO of Pew Capital. And then the far right, we have Deanna Hobson, Deputy CEO. And in the middle, we have Darius Cayetano, Portfolio Manager and Co-Head of Investment Grade Bonds. The trio will provide a brief overview of Pew Capital, then dive into some fixed income education. Next, they'll review the LACERA mandate and conclude by sharing their views on key investment themes. Before they start, let me provide some background on the relationship as well as context for the portfolio. The relationship between LACERA and Pew Capital dates back over 20 years. Pew Capital started managing a core bond portfolio for LACERA in the summer of 2005, originally as part of our Emerging Manager program. After several years of solid, consistent performance, the firm graduated out of that program in 2018. Over the years, what started with an initial investment of $50 million has grown from additional capital contributions plus compounded returns to over $930 million today, representing about 1.1% of LACERA's fund. The Pew Capital portfolio is part of the LACERA's investment grade bond composite, which resides within the risk reduction and mitigation functional asset category. As the name suggests, the role of this functional category is to reduce the total fund's risk and to provide downside protection and diversification. Investment grade bonds contribute to this goal by generating income, having low price volatility, and low correlation to growth assets. Now, this chart on the screen provides a top-down view of the fund. As of the end of June, the LACERA fund was valued at approximately $85 billion. The top bar shows a breakdown of the fund into its functional asset categories. Risk reduction and mitigation, shown in dark green on the top left, has a target allocation of 24%, or roughly $20 billion. Drilling down to the next row, we see that investment grade bonds in the slightly lighter green comprise 13 of that 24%, about $10.7 billion. Now, the bottom row shows the managers in the investment grade bond composite. On the left, we have a a passive mandate, an index fund, which represents 72% of the composite, and 2 active managers. The Pew portfolio is the light blue portion in the far right. So with that as introduction, let me turn it over to the Pew team.
Thank you, Vache. That was a great introduction, and we really appreciate being here today. I will start with a little about our firm. And if you could turn to slide 5. Pew Capital was founded in 1991. So next year we will be celebrating 35 years in business. We are a Seattle-based institutional fixed income investment manager. When LACERA first partnered with us in 2005, we had a total of $900 million in assets under management. We have since grown to just under $13 billion in assets, offering fixed income solutions to over 50 clients around the country, many of whom have long tenures with us, like LACERA. If you could turn to the next slide. From the start, we understood that we are not just managing assets. These dollars represent the financial security of real people. We take that responsibility very seriously, and that awareness shapes everything we do. Our approach to investments has always been rooted in rigorous research, collaborative decision-making, and a disciplined approach to risk management with a long-term perspective. As we have grown, we have maintained our focus on fixed income. We don't manage equity or alternatives, which allows us to concentrate our expertise and resources where we believe we can deliver the most value. Our team is both experienced and stable, and many of our professionals have been with us for decades. This continuity has fostered a strong business and a consistent investment philosophy and process, and ensures that institutional knowledge is passed forward. Over the years, growth has allowed us to deepen our capabilities, develop the next generation of investment professionals, while maintaining true to our identity and to the principles that have served our clients well. With that as background on Pew Capital and the relationship we've built with LACERA, we'd like to turn to the current fixed income markets and share some insights with you. Mary.
Thanks, Deanna. If you could turn to the next page, please. So just to start out, first of all, thank you, Vache, for allowing us this opportunity to be able to share insights on the fixed income market. We're excited to be before the Credit and Risk Mitigation Committee. And one of the things I want to do is just start with a little story. So I started my career 45 years ago, basically in 1991, came out of college with a degree in economics. I had no idea what a bond was, and I had no idea what a stock was actually when I came out, and was fortunate to actually land and start a career in the treasury area. And then be able to move on to the investment side as well. And when I started, one of the things I realized is it seemed very, very complex. And in fact, I think they deliberately make it complex. And so one of the things I realized was like, it can be relatively straightforward. And so I'm hoping the way that we build the presentation today will build a platform that will help you understand what is a bond, what are its characteristics, how does it get put into an index, and just build on that to then how are we managing your portfolio, and what is our outlook. So that's kind of the intention today. I really would love to have it be engaging, so I hope you guys will ask questions. We brought bribery, so we did bring some chocolates. So anybody who asks a question is going to get a chocolate. If you ask more than one, you can get a couple. So with that, I'll start out and just talk about the LACERA insights and the role of fixed income. So to start, asset allocators use fixed income for a variety of different purposes. And Vache talked a little bit about the different aspects of fixed income that are in your portfolio. Part of the goal that LACERA looks for fixed income to provide to the portfolio is current income. It's also capital preservation. It's a source of liquidity. And that tends to be very important for pension funds. And it also is a diversifier away from the growth assets in the portfolio. So it has a much lower correlation to that and lower volatility generally. The approach that is taken is an active management approach as well as a passive. But in our case, we're focused on the active side. And all of the portfolio securities are investment grade securities. So if we can move to the next page, where I wanted to start out is to really think about what is a bond. And a bond is basically a loan. And so it has interest that is paid to the person that gave the loan. And then it also, you get your principal back. The difference is that a bond actually trades in the market and it's securitized. So this is an example of a bond. It's a Starbucks bond. So the issuer of this bond is Starbucks. It has a coupon of 5.4%. So that's what basically the investor is going to receive on an annual basis. Its maturity is 2035. And so therefore that makes it a 10-year. And its duration is 7.34. Now, duration is a term that is used in the fixed income market. Basically, what it does is it measures the price volatility for a 1% change in interest rates. So let's go through the cash flows of the bond, and that's on the left-hand side. So this bond is a $100,000 bond that was the investor purchased. Again, the coupon is 5.4. So how we would get to the annual payments is we would say 0.054 times 100,000. We're going to get $5,400 a year in income. If we held this bond to maturity, so if we held it for the entire 10-year time period, then we would get $54,000 worth of income, and we would get our $100,000 back that we loaned, in this case, Starbucks. So that's kind of the cash flows of the bond. A couple of insights from this is if you think about the bond for only 1 year and say, okay, I'm only going to get $5,400 in annual income, then it doesn't reflect sort of really the true power of the bond, which is the longer you hold it, the more income you get. And the more income you get, then the less you would worry about price changes and interest rate changes. So that's kind of one thing. A second thing that is just important to know about a bond when you think about it is if you buy a bond today and it's 10 years and you hold it for 5 years, then you have 5 years left, right? So it actually, over time, the maturity decreases and also the volatility of price decreases and the income becomes more and more relevant. So that's kind of if you hold it to maturity. On the right-hand side, what I thought would be interesting is to show what happens. So part of what is different about a bond than a loan is that the bonds tend to actively trade in the market. And so if you bought a 10-year bond today and you said, what happens if interest rates move up 1% or interest rates move down 1% to the price? What an immediate shock. This chart really shows that, that math, and I'm going to walk you through it. So today, the price of the bond would be 100.33. If interest rates went up 1% or 100 basis points, and in the bond market, 100 or basis points is used regularly, but 100 basis points equals 1%. So that's the bond language. Then the price is actually going to drop. Interest rates going up is negative to the price of a bond. So there's an inverse relationship, and that 1% impact is going to equate to a price of 93.09 or a dollar hit of 7.24. Does that make sense? Now, the opposite is also true, is that if interest rates go down, then the price of the bond is going to go up, right? So it's going to go to that 108.11, and there's a gain of 7.78%. So part of when people talk about total returns as opposed to yields, the total return is capturing the movement in prices as well as the income and the reinvestment of that income. Why would somebody invest in a bond relative to, say, a stock? We talked about diversification, and I just want to use an example while we're here on one bond. So when do you think interest rates go down? I'm going to just ask a question. Does anybody have a thought of what might drive interest rates to go down?
Two factors. One is employment rate, one is inflation. So that's the Fed's mandate. So they decide on interest rate based on these two mandates. And I think they might cut rate.
Okay, that's good. So if the unemployment rate was going up and the economy was slowing, then bonds actually are likely to rally or rates are likely to go down. So that's great. Okay, so if that's happening, then bonds are actually going to add a kicker to an asset allocation process because equities are less likely to be doing that same thing. So it creates sort of that diversification in terms of the impact. Okay, I'm going to stop here for a second and ask if anybody just generally has any questions about this particular slide.
She mentioned chocolate.
Oh yeah, you do get a chocolate. Okay, so yes, you can go give her a chocolate. Okay, so okay, then let's move. If we can move to slide 11, please. Okay, so now here's the question then. What is one defining characteristic of a bond that you can take away from just the last slide?
I can take a guess.
Okay.
The fixed income portion of it.
Okay.
I know
So
what to expect that portion.
It's got a fixed income. How about the coupon? Is the coupon important relative to maybe a different kind of investment? Yep. Okay. All right. So we've talked a little bit about a bond. If we can move to page 12. Now we're going to move. So that one bond, it goes into an index. And there's an index which your portfolio is actually managed against called the Bloomberg Barclays Aggregate Index. That index is actually a broad fixed income index, investment grade oriented. It is the most commonly used fixed income index in the United States. The index includes government securities. It includes mortgage securities. It includes corporate securities, asset backs, and commercial mortgage-backed securities. It is securities that are fixed rate only with maturities of at least 1 year. Those are the things that are actually that go into this index. This index, and we include in this graph, we want to show you how this index has changed over time. So what's included is the gray represents government securities, and then we show in the green and the blue credit securities and securitized securities. You can see it has grown dramatically. So over the last 30 years or so, it's grown from 4 trillion to over 31 trillion. Part of why this is important is it shows how significant this index is and how big the bond market, the investment grade bond market is. The other component that is interesting is just to think how fast it has grown. So it's grown from, on average, 7.2% a year, so much faster than GDP has grown. So this is the index that you guys use, and we're going to break it down a little bit. If we can move to page 13, what we show here is, if we can move to page 13, please.
Slight delay.
That's okay.
We'll get there.
Well, while it's doing that, maybe on page 13, what we're going to show is really the breakdown of the index between the different components of it. And just one of the interesting things about the aggregate index, when I think about it, it's actually a living, breathing index. It changes over time. It reflects what's going on in the economy. And even the asset allocation within the index does that. So if you think back, there was a period under the Clinton administration, for example, where we had a surplus. And back then, it meant that government securities were not being issued. Debt was not being issued in the market. The government was not needing as much funding. And as a result of that, the government component went down, right? So when you look at this index, there's actually all kinds of stories underneath it that make it very interesting from an investment standpoint. You can see that in 1995, so 20 years ago, which is when we were funded by LACERA, the government index component was 55% of this benchmark of the aggregate index. The credit piece was only 17%, much smaller. And the securitized piece, which includes mortgages, commercial mortgages, and asset-backed securities. So basically it's called securitized because they all have underlying assets that are pledged to create their credit quality profile, was 24%. So that, if you look at it now though, government has grown quite dramatically. So we show it's at 15.3 trillion. You can see it's moved up a lot. And particularly you can see versus 2020, the pandemic, right? So if you look at this, and it was 9.8 trillion and it grew to 15.3. And that's the fiscal spending and stimulus that came to support the economy as we tried to move out of the pandemic implications. So that's the breakdown of this index. The next thing we want to share is actually the credit quality. And so the credit, and I'm just going to anchor, the credit piece of this index is 24%. So of the aggregate index, the broad fixed income index, 24% is credit, or 7.4 trillion. If we can turn to page 14, we're going to break down that corporate index by credit quality. And just again, to sort of start, so for a corporate issuer to be in this index, the issue size has to be at least 300 million in debt. It has to be fixed rate, and it has to have a minimum maturity of 1 year. And typically, most of the issuers are in 1 to 30 year. In the last 10 years or so, some of them have started issuing 40-year bonds. But that's sort of the maturity complex. This shows actually the credit quality. And to be investment grade, it basically includes AAA, AA, single A, and BBB issuers, down to BBB minus. And so again, if you look at this from a historical standpoint, in the 1990s, actually 20% was either AAA or AA, the highest credit ratings, and 51% was single A. So 71% of the index was the top 3 notches of investment grade. Today, looking at the green one, you can see it's actually much more evenly distributed between single A and BBB. But BBB has become very dominant relative to that historical profile. And if we think about some of the things going on in the economy and with corporations and those kinds of things, the willingness to issue debt, the willingness to buy debt, to use leverage, all of those things are much more common today than they were 20 years ago. This index actually has 8,500 issues in it that make up this corporate index, so it's very diversified. The average credit quality of the index itself is A3, so the lowest rung of A, and then BBB plus. So you can see that pretty even split basically means that's where we would end up. And then the last one that's sort of focused on the index is on page 15. And most people are very familiar with the S&P 500. This is Vache's favorite chart, by the way. So what we wanted to do was share what does the S&P 500 look like versus the investment grade corporate index. And there's something that two bars that stand out quite significantly. It won't be a surprise to anybody on the S&P 500 that the biggest market value contributor is technology. It accounts for 32% of that index on a market cap basis. In contrast, it's only 10% technology of the investment grade market. But the investment grade market is dominated actually by financials. So banks, insurance companies, REITs, and that accounts for 34% in contrast to only 14% for the S&P 500. So really, they're both very high quality indices. A lot of the S&P 500 members are actually issuers in the bond market. But the difference in debt versus equity is relatively significant. So I'm going to stop. This is kind of the index component and see if people have any questions on the index or, the Starbucks bond is one of, 8,000 bonds in this part of the index.
Fellow trustee, anyone have questions? A question. I have also Trustee Rui joining us right now. I do have a question. If you go to slide 12. This chart is very insightful. Since I joined the board, I have always been watching this government debt to GDP ratio, something that have been concerned. And this chart show it again, it's really high debt to GDP ratio. And then I also may want to have seen it recently too this year. The US credits also has been downgraded. So in this setting, how does affect the government bonds market and what's the implication to our LACERA investment?
Yeah, so the government bonds have been downgraded from AAA to AA at this point. And I think that it's accepted that that's okay at this point. What you're starting to see, though, is the market respond to longer term concerns and the implications with deficit spending continuing to increase. And so there's more concern with, like, if you looked at the 30-year part of the Treasury curve, that part is decoupling somewhat relative to the shorter maturities. And it's reflecting some of that concern and that risk. And part of the challenge is the longer you go out, the less there is known, right, in terms of the outcomes of policies and those kinds of things. So that's one implication, is that the curve is likely to be steeper on the back end because risk premiums go up to reflect that uncertainty. The second one is actually also reflected, and you can see it on this page with the gray, where it really it steepens up, right? So the growth in government debt is increasing, and therefore part of the concern would be what is the value, or who is going to buy it, and what is the penalty that they will assess to make that purchase. So I would say those are a couple of things.
Thank you so much.
You're welcome. Thank you for the question. With that, I'm going to turn it over to Darius.
Good morning. I'll pick up on slide 17. Mary articulated much of what is wonderful about the Bloomberg US Aggregate Index. It's large. Many of the securities are liquid. It's an ample foundation and anchor from which to build a portfolio that is intended to deliver current income and work as a diversifier in your broader asset allocation. The mandate that LACERA has asked us to manage is to deliver a 25 basis point or 0.25% net over the index. It's also, we talked about the aggregate index using primarily investment grade securities. So this has been well covered by Mary and done well. We also have an item here called tracking error. It essentially means that the lower that number is, the less risk you're running or greater or difference from the portfolio, from the index rather. You want to be different from the index to some degree, but you don't want that to be outsized, or it is counterproductive to the goal of why you've chosen that particular benchmark. We can move to slide 18. We will discuss the portfolio in terms of similarities and differences relative to the index. At the top left, starting with the table characteristics, you see the duration number shows up once again. So that is talking about interest rate sensitivity, which Mary discussed. Again, a 1% move up means, in terms of interest rates, means roughly a 6% decline in terms of market value or price. And the converse is also the same. The portfolio then, the LACERA portfolio, which is the middle column, has a similar level in terms of duration as the index. So interest rate sensitivity is similar. So if that unemployment number does spike, we would expect the value of the portfolio to move at the same amount as the index. One of the things that's also different, however, is that the yield to worst, or the yield, that expected return, is 23 or 0.23% greater for the portfolio than the index. And that is a function of the composition difference. In terms of credit quality, the average credit quality is slightly below that of the index. I think of this as being on a freeway and choosing to go perhaps in that second to the right lane. You're still traveling at a reasonable speed, but it allows you to pick up a little bit more return and get to your destination a little bit faster. I've been driving on the freeways in LA a lot recently, so it comes to mind. In terms of composition difference, we can look at the table, or the chart rather, of sectors at the bottom. It shows that the blue bars are the index and the green bars are the portfolio. So you can note that a major difference is that the government portion, which is largely treasuries, is lower within the LACERA portfolio. To generate a higher yield, we've allocated more to mortgages as a diversifier. These are also rated similarly to the US Treasury, but it offers a much better return or expected yield. In terms of the credit portion, and I will add the 0 to 10 and the 10 to 30 together, there's 2% more in the credit allocation than in the index credit allocation. And that's also because it's a great place to also deliver a higher level of return. And we currently think that corporates are in a fairly solid position currently. We also have a component, asset-backed securities. These are your credit card receivables. These are also auto loans, and they're packaged together to make highly rated securities. It's a great diversifier to the portfolio relative to front-end treasuries. You have a higher level of interest rates, a higher level of carry, and it is a shorter duration, so the volatility, the sensitivity to rates is a lot less. We also have commercial mortgage-backed securities in the portfolio, which is relatively aligned to the index. So these are some of the composition differences that lead to that higher expected return. We can also touch on credit quality on the top right. Roughly 80% of the portfolio has securities that are rated A or better. This means that it's very high quality and supports, again, that mandate of being defensive. We do have some BBB allocation, but even the BBBs themselves, they're weighted towards the front of the curve, so less sensitivity in terms of spread volatility. It also does enhance the quality of the return. Also, BBB issuers, and we can talk about this a little bit later, have been improving their credit quality, so it has been highly beneficial to the portfolio. And with that, I'll move on to slide 19.
Just hold up for a second while we lost the slide, so.
Is somebody helping us to bring the slides back?
Yes, yeah,
Thank you.
that's why Linda went out.
I can provide some of the just general color without necessarily, and we can, until the slides come up.
Okay.
So I mean, we'll see the numbers when the slides come up, but big picture of the longer time horizon, the LACERA portfolio has outperformed the benchmark and met on a net basis the return targets. That's really the high level takeaway. And with that, I can kick it back to Mary. Oh, here are the numbers in front of you. So we can look at since inception, so 3.39% versus the 3.09 in excess of the 25 basis point hurdle. It has also performed similarly in the shorter horizons. With that, I can hand back to you, Mary, unless you have other questions.
Yeah, thanks, Darius. If we could move on to page 21, please. So now we're gonna shift gears. So we've talked about what is a bond. We've talked about what is the index. We've talked about how is your portfolio positioned relative to that index. And we've talked about the performance of your portfolio. Now what we want to talk about is our outlook going forward and insights that we think might be valuable to you and that we think are important in how we're managing portfolios. The first one is that fixed income yields and carry are attractive. Secondly is while we expect the economy to slow, we don't expect a recession. That's important because that's a risk element to risk assets. And third is that diversification provides a valuable both yield and risk management relative to treasury securities, which goes also to your question, right? I would add just to that question that one of the things is as the governments go, they're now AA, they actually are headed much more into the realm of corporate ratings than they were historically, like the government rating and the risk-free rate, right? So that's a little bit of another risk that's there. So with those three as the headlines, let's dive into it. And if we
Mary,
can move.
I've got a
Oh,
question
yeah.
for you. Yeah, from a bond market perspective, do you look at a set of macroeconomic factors? So I'm curious about your recession thing, right? And most people would say that ultimately, you know, the grander market is always disciplined by what they call the bond vigilantes, right? At the end of the day. So is there, when you're looking at the macro factors going on in the economy today, I see a lot of people who kind of still feel a slowdown below stall speed is possible.
Mm-hmm.
I'm curious just in terms of when you look at the numbers, employment's kind of like an obvious one of the things, but like what other things are you looking at across the fixed income spectrum that's perhaps predictive, or you draw some inferences in a different way than say your average equity, investor on that side?
Yeah, that's a great question. Maybe we could switch to slide 26 and jump ahead. I think it's 26, 27. Yes. Okay. So maybe just to start out, Patrick, and give some thoughts. One of the coolest experiences I've ever had in my career is actually the opportunity to serve on the Seattle branch of the San Francisco Federal Reserve. And so I did that for 6 years in the kind of in the late 80s, early 90s kind of time period. Or no, I got that wrong, but sorry, in the late 90s, early 2000 time period. And so part of what you do when you do that is it actually makes the economic numbers start on a monthly basis about what's going on in your business, what's going on in the economy around you, and specific questions. And so you start to see it not as a number, but actually as the story of what's being lived around you, right? So when you think about the economy from my perspective, you really do want to look broadly across. So employment absolutely is very important. But I think one of the other elements that we've come to really understand and value is the concept that actually the economy is very diverse. And that diversity allows it to be resilient. And we've really seen that over the last couple of decades. And so when we were thinking about what's going on in April and, crazy time periods, right, is like part of it was how do you create certainty around uncertainty, right? What can you control as leaders? What can you control as investors and those kinds of things? And it's actually part of the reason we came up with those 3 themes that we're going to talk about. And so this chart is on the right-hand side, shows GDP. And it shows GDP going back to 1980. And what percentage of GDP is split into different categories of growth rates. So the growth rates are on the bottom. And then the percentage of time is on the left axis. And the orange represents the percentage of time that GDP has negative growth. And it's only 12% of the time. And so it's sort of the idea of trying to anchor around the probability of what you're likely to experience. And that probability has to do with a variety of different things, starting with the diversity of the economy. And if you go back and think about the tech piece of the S&P 500, part of what is growing some of the positives that offset some of the negatives is really around AI and technology spending and evolution. And in the case of the United States, part of it is the innovation that we've had. And the issue is, does that get beaten out of us? Or does that actually resilience continue to rise and be positive? So our expectations are we do see signs of slowing. All the education elements that are going on are a big red flag in terms of policy initiatives and those kinds of things. And so, all of those elements are in play. But you are also seeing resilience in how people and businesses and even the universities are thinking about how they respond to that. So that would be not a short answer, but.
Well, no, I appreciate that. I think the only follow on I would have is I've listened, gone to conferences like the other trustees, and you always hear the macroeconomic person is, when I see a chart like this presumes a certain leadership regime and temperament that doesn't exist at present, right? So if you have a more capricious regime ahead, how do you overestimate security based on past results, or do you, how do you? I was just curious from a bond perspective, since it seems to be the most sensitive to changes. How do you potentially model a capricious executive with kind of global impact in areas that you haven't really had to worry about? You've had the comfort under a certain rule of law regime from that perspective. So just curious if you have to think about it at that level, or you.
Yeah, no, you do. And I think when I was thinking about it, and I have to say I was, it's very easy to be super stressed, right, in the kind of environment that we're in. But then you want to step back and say, okay, what are the things that you can control and what does it mean? And so the exciting thing about that for fixed income investors is really this story about yields being attractive. And it's the story about the fact that you get the certainty. So bonds have a certain maturity. They have a certain cash flow that goes with it. And that's the Starbucks example that we went through, right? So if you said in a world of uncertainty, as an investor, if you wanted certainty, if you buy a bond, you've got certainty, right? And so part of the reason why we actually are emphasizing this yields are attractive is actually because that's sort of a certainty element within an uncertain world. And it leans into the space of where we invest and where our clients invest. And so just not to lose sight of that.
Yeah.
And so when we go through a couple of the other slides, we'll talk about like some of those risk factors. So the fact that corporate spreads are really tight is an element.
Thank you, Mayor.
Yeah, no, perfect. Thank you for the question. Those are all great. Yeah, we've got 14 minutes.
Yeah, if we can wrap up maybe 5 minutes before, that'd be good.
Okay. All right. So if we can, I'm totally off kilter on pages, but we can go back. Does anybody know slide maybe 22? How about 23? Okay. So I thought it would be fun to do a little quick show of hands here. How many people think interest rates were higher in 2005 than they are today? Raise your hand. So everybody thinks. Okay. All right. So then the second question is, how many do people think rates were higher or lower in 2020? Lower? Okay, perfect. That is absolutely correct. Okay, so if we go to page 24, I'm going to speed myself up some. This shows the 10-year treasury rate over the last decade. And on average, the yield has been 2.62%. But if you look at 2020, you can see it was 0.7. It actually had a range that year of 0.5 to 1.8%. And that was the pandemic year. So the interest rates were down. They were lower because, in fact, we were in very distressed conditions and temporarily, at least, recessionary conditions. But if you look at what's happened over the last 3 years, you can see the average has been between 4 and 4.3. So yields are much more attractive. If we take a longer term look on the right, you can see the 10-year treasury, and this is Patrick's comment. The 10-year treasury actually in 2005 was very consistent with what we're experiencing in 2025. So about the same range for the year. But in between times, it's been much lower. And so when we look at this and think about the opportunity to invest and actually get that strong coupon interest that can compound, we see that as fixed income is attractive. Moving to page 25, we're going to show the corporate index, and corporate yields also are very attractive. And you can see that in that same time period, they're at the upper end of their trading range. So we see corporate yields as attractive. On the right, we wanted to contrast another valuation approach, and that was the BBB index for investment grade against the S&P 500 earnings yield. The earnings yield is the orange line. It's been relatively stable. But because interest rates on the bond side have gone up quite significantly, yields for bonds look much more attractive than the earnings yield for the S&P 500. The average is about 21 basis points or 0.21, and it's currently at 143 basis points, so about 120 basis points more than the average. So all of those kind of indicate corporates are attractive. If we move to page 26, page 27, we've covered the right-hand side, but on the left-hand side, one of the dynamics that is going on this year, and it really speaks to the issues coming out of the executive orders and some of the various policies, is you've seen sentiment, consumer sentiment and business sentiment crash, go down pretty significantly. But even while you're seeing that, you've seen the economic indicators hold up better than you would expect. We're starting to see some cracks in that in terms of the employment. And so part of this issue is the issue that you were asking your question about. It's, is the sentiment likely to be translated into the hard data as we move forward? Or is the hard data going to stay low and the sentiment is going to improve over time? And we've seen volatility around that this year, and I think we will continue to see that. And I'm going to wrap up on the next page, page 28. And this is the issue also to some degree, Patrick, that your question touched on the left-hand side, and it's that corporate spreads are actually very tight. And so while we think corporate yields are very attractive, and I want to make sure I explain what corporate spreads are. So the treasury is considered the risk-free rate. So that Starbucks bond, if the 10-year treasury was 4% and Starbucks yield was 5%, then that 1% difference between them is the corporate spread. So it's the amount that you're compensated to take on corporate risk instead of treasury risk. And what's interesting is that corporate spreads are at the tightest levels in the last 15 years. So they are not pricing as if corporates are risky, and they are not pricing as if there's a recession. They are pricing as this sector is attractive. This is one of the risks, and Darius will talk about this a little bit more. But I wanted to leave you with the graph on the right. This is a Morgan Stanley graph. What they did was they looked at GDP growth, and that's shown on the bottom, different growth rates for GDP. And then the triangle is the excess return for credit above treasuries. And so if it is above 0, it means that investing in credit over treasuries, you're compensated for that. If it's below the line, it means that you would have been better off being in treasuries than corporates. And you can see when GDP is negative, so those are the two left-hand side bars. When GDP is negative, then corporate credit doesn't tend to do well. Equities would follow a similar pattern. But if you think that growth is going to be positive, then being overweight credit modestly makes a lot of sense. I've taken all of Darius's time, but I'll turn it over to you.
I will say what I have to say, hopefully in a minute or less. On slide 30, the big picture is over the next over the next slide or so, just the importance of being in assets other than treasuries. Big picture, when you go to borrow money, a mortgage, they want to know what your income is. We ask the same question of corporations. What's the ratio of your debt to your income stream? For corporates, we generally call that EBITDA. The picture shows on the left that the rate of debt expansion or growth has been less than the rate of EBITDA growth. So EBITDA has been growing higher, or cash flow has been growing higher, which means that companies have actually been deleveraging more. So not as much rapid growth in terms of leverage. This has been constructive and supportive for the credit environment. I talked about triple Bs and why your portfolio has triple Bs in it. On the right is the reason why. Many of the triple B issuers have been upgraded more, so you can see that. That's the dark green bar on the right. And that has led to credit quality improvement for the index, which Mary talked about earlier, and that has also been beneficial for the portfolio. Full stop. Slide 31 shows mortgages. It's another component that we invest in. The corporate spreads, mortgage spreads are much more attractive now relative to history than corporate spreads, relative to corporate spreads. It means that that's also an appealing place to invest. And we also talked about the credit quality of mortgages being similar to that of treasuries. So that is an interesting place and also a good place to earn additional yield. I will actually stop there because we need to get you to your other meeting. That's the big picture.
Thank you. Really, really appreciate this presentation. I learned a lot. And then, as you know, LACERA is a learning organization. Every one of us learning every single day, so including trustee. So thank you for helping us. To our staff, I know this is from our request about years ago. We spoke about concern about trustee education. And then I want to thank you, really heard us. And then in this whole year, almost every single committee meeting has been excellent education session. So we really appreciate that. Perhaps maybe in communication team can clip those education session, put in a library for people that cannot make it, still can watch. So, but thank you again. Yeah, thank you for participation.
And I'm giving the chocolates.
Okay. All right. Thank you.
Oh, yes, we have the quorum to approve minutes now. Okay.
Share these with you.
Oh, thank you.
They're from Seattle.
Thank you. That's amazing. I'm gonna pass along.
Yep.
Yeah. Good morning. Excellent. Now we have Trustee Ru join us. I believe we have quorum now to approve minutes. Is that right, Linda?
Yes. we just
All
need a
right,
motion
so
and a
let's, anyone have question on the minutes? Or one change? No?
Motion to
Okay,
approve.
thank you. I will second it.
Okay, Ms. Mead,
Yes.
Mr. Jones,
Aye.
and Mr. Rue?
Yes.
Okay, the motion passes unanimously. And then no items for review. We don't have any items for future agendas, good of the order.
Good order. Thank you, everyone. Meeting adjourned.
Any comments? Okay.
Start the BOI at 9:05.